Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Intuit.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And a quick note before we get into today's stock. If you trade stocks, crypto, forex, gold, or indices and want clearer buy and sell signals, you can check out VIP indicators through my link below. Grow $100 at $10K with VIP indicators. VIP indicators offers TradingView indicators, market alerts, trading education, and chart reading support with up to a 93% win rate. The tools are designed to help traders spot possible setups faster and trade with more confidence. But please remember, trading is risky. No indicator can guarantee profits, and growing $100 into $10 is not guaranteed. Use these tools for education and analysis only, manage your risk carefully, do your own research, and never trade money you cannot afford to lose. This is an affiliate link, so I may earn a commission if you use it at no extra cost to you.
So it is genuinely fascinating to watch the market just completely lose its collective mind over a shiny new narrative.
Oh, absolutely. It happens all the time.
Right. Like completely ignoring the mechanical reality of how a business actually works.
Yeah.
I want you to picture the current AI boom, like this fleet of incredibly fast, cutting-edge sports cars.
Okay. I like that visual.
And Wall Street looks at these generic AI models and assumes they're just going to outrace and destroy every legacy software company out there.
Yeah, that's the prevailing story right now.
But they're forgetting a huge detail about industries like finance and tax compliance, because these aren't open highways. They are highly regulated, deeply complex private toll roads.
Right. You can't just drive wherever you want.
Exactly. And it doesn't matter how fast your AI sports car is if it literally isn't legally allowed on the road.
That is just the perfect way to visualize the contradiction here. Because Wall Street is pricing in a scenario where those generic AI cars just, plow straight through the toll booths.
And that assumption has created what might be the most baffling dislocation in the market today. I mean, we are looking at a top-tier software giant that dropped 40% in value.
40%. It's
Yeah.
massive.
Right, because the consensus is that AI will destroy them. But when you actually look under the hood, their real-world revenue is surging.
All right, let's move into the wealth building context. Because to really understand how mispriced Intuit might be, we have to unpack that fear.
Yeah, let's dissect the fear first.
The specific catalyst driving that massive drop is this emerging concept of agentic AI.
Right, and let's pause and actually define that for a second. Because, AI is a buzzword that gets slapped on everything from refrigerators to spelling checkers.
Oh, for sure. Everything has AI now.
But when we say agentic AI, we aren't talking about a chatbot drafting a polite email.
Not at all. The primary bear case, and the reason institutional investors have been aggressively hitting the sell button, is the fear that autonomous AI will execute multi-step workflows entirely on its own.
Like without a human double-checking it.
Exactly. The narrative assumes a small business owner won't need a QuickBooks or TurboTax subscription anymore. They'll just tell an open-source AI agent, hey, balance my books and file my corporate taxes.
And it magically runs in the background for free.
Right, that's the fear.
Okay, I have to jump in here. Because that narrative sounds terrifying if you hold the stock, but it completely ignores legal liability.
Yep, the compliance factor.
I mean, if you ask a generic language model to write a poem and it makes up a word, that's a hallucination. It's a funny quirk.
Nobody goes to jail over a poem.
Exactly. But if that same AI hallucinates a tax code deduction from 1998 on your corporate filing, the IRS does not care that you used beta software.
No, they definitely do not.
You are the one paying the penalty. You are getting audited.
And you just hit on the exact structural flaw in the bear thesis. Tax compliance requires deterministic accuracy, not probabilistic guessing.
Right, you need certified guardrails.
Intuit's core competitive moat is built entirely on that regulatory complexity. Pure AI tools cannot simply bypass those hurdles.
And they're actually extending their reach too, right?
Yeah, this is a major structural pivot. They are aggressively moving upmarket.
Which genuinely surprised me. Because when you hear QuickBooks, you think of like a local bakery or a freelance graphic designer.
You don't think of complex corporate entities?
No, not at all. But revenue from QuickBooks Online Advanced and the new Intuit Enterprise Suite is up roughly 40% year over year.
Which proves they are successfully capturing those complex mid-market businesses, companies with 50 to 500 employees.
And in the past, those companies would just outgrow QuickBooks and migrate to some clunky legacy ERP system, which is a total nightmare.
12 to 18 months of integration, massive consulting fees. It's brutal.
Right, so Intuit just built the back-end power into the interface people already know.
Exactly. Now let's look at the fundamentals, because if AI is supposed to be eating their lunch, the actual Q2 fiscal year 2026 data completely contradicts that story.
It really does. They just reported $4.7 billion in revenue for Q2.
Which represents a 17% year-over-year growth rate.
On a massive base, yeah. And if you dig into the segment data, QuickBooks Online accounting revenues specifically surged 24%.
And even stripping out the MailChimp acquisition, the core online ecosystem grew 25%.
I'm looking at these numbers thinking, if AI is an existential threat, how are they growing at 25%?
Because they aren't victims of AI. They are actively deploying it within their own regulated environment.
Right. They own the toll booth, and now they're handing out their own AI cars.
Over 3 million customers are already using Intuit's proprietary AI agents, and they boast an 85% repeat engagement rate.
Oh, wow. So it's actually making the product stickier.
It's driving the average revenue per user up, not causing churn. But beyond growth, we have to talk about the cash engine.
Yes, the free cash flow. Because for anyone trying to separate real business from hype, cash flow is the only metric that matters.
Absolutely.
Over the last 12 months, Intuit generated $6.8 billion in free cash flow. That is a 34.2% free cash flow margin.
Meaning for every dollar coming in, 34 cents becomes pure cash in the bank.
It's an unbelievable margin. And management used that cash to aggressively repurchase their own stock. Between November 2025 and January 2026, they bought back 1.56 million shares.
We're almost $1 billion.
Yeah, which is management screaming to the market that they think the stock is deeply undervalued.
And the multiples validate that. The forward price-to-sales ratio collapsed to 4.67. The industry average is over 7.
It's a huge discount.
That brings us to the catalyst timeline. Upgrading the stock based on cash flow is defensive, but what is the offensive wildcard here?
The thing nobody is fully pricing in yet.
Right. And it's highly speculative, but it revolves around their multi-year partnership with Anthropic, the creators of the Claude AI models.
Okay, so how does that actually work mechanically?
Imagine if Intuit's heavily regulated financial data is surfaced directly inside Anthropic's enterprise products via API.
Oh, like a CEO asking Claude about their real-time cash runway.
Exactly. Claude doesn't know that. But it seamlessly pings the Intuit integration, pulls the compliant data, and delivers the answer.
So Intuit becomes the indispensable financial plumbing for the entire AI ecosystem.
It flips the script. They become the primary, deeply embedded data layer.
That's massive.
Yeah.
And it makes their upcoming earnings release on May 20th, 2026, a very critical date to watch for any breadcrumbs on this.
Definitely. Now let's pivot to the chart, because the mechanics of how the stock is trading are fascinating.
Yeah, Intuit is trading in this incredibly well-defined historical demand zone.
Between $380 and $420.
And what's wild is that algorithms and value buyers clearly see this as the absolute floor. It has bounced off this exact level 8 separate times before.
And historically, those bounces generate average peak returns of almost 35%.
Which makes sense because the valuation multiple gets totally crushed down here.
Right. At the peak, it was trading at a 39 forward multiple. When it hit the support band, it compressed all the way down to roughly 16 times earnings.
That is a brutal psychological reset.
Yeah.
The market went from pricing in perfection to pricing in a total doomsday scenario.
So what does market sentiment look like? Well, we are starting to see a shift. Over the last week, the stock actually gained 3.1%.
Outperforming the broader software sector, yeah.
Dip buyers are stepping in, and Wall Street is waking up. Rothschild & Co. Redburn upgraded it to a buy with a $700 price target.
And consensus targets suggest about 42% upside from where we are right now.
Wall Street is finally shifting away from the wall of worry.
Okay, but we have built a very strong bull case here.
We have.
Now let's talk about the risks. We have to responsibly look at what could still drag this down. What remains of the bear case?
There are two distinct mechanical headwinds dragging on consolidated growth: MailChimp and Credit Karma.
Right. MailChimp is the marketing side, and Credit Karma is the consumer finance side.
Let's start with MailChimp. The momentum there has slowed down. Integrating a marketing platform's architecture into a deeply entrenched accounting ecosystem is a much heavier technical lift than they anticipated.
I mean, that makes logical sense. The brain of an accounting software is totally different from a marketing engine. It takes time. What about Credit Karma?
Credit Karma's issue is entirely macroeconomic. They make money on referral fees for personal loans and credit cards.
Oh, so they are hypersensitive to interest rates.
Exactly. When rates stay high and banks tighten lending, transaction volume drops, and Credit Karma gets squeezed directly.
I hear that. MailChimp is a technical headache and Credit Karma is cyclical. But I have to ask, does a slowdown there justify a 40% haircut to the whole company's market cap?
And that is the pivotal question.
Because to me, buying at a 16 forward multiple means you are no longer paying for flawless execution. The bad news is already mathematically baked into the price.
So with everything on the table, what's the final verdict?
Yeah, where do we land?
When you balance the overblown AI fears and the cyclical headwinds against the accelerating core business and that pristine cash flow, the structural thesis generates an 8 out of 10 bullish score.
An 8 out of 10 is very high conviction right now.
It is. The market has fundamentally mispriced a high-quality compounder. The view here is a multi-year hold, roughly 12 to 24 months.
So the goal is to ride out the multiple expansion back to historical norms.
And capture the compounding effect of their upmarket expansion.
It really is an incredible setup when you zoom out. You have this narrative of a company being destroyed by AI, but in reality, they're sitting on massive support, buying back their own stock, and using AI to capture bigger clients.
It's the perfect case study in how broad market narratives create institutional blind spots.
And if you want extra help reading trading charts, you can check out VIP indicators through the link below. The campaign is Grow $110K with VIP indicators, and their tools include TradingView indicators, market alerts, and trading education with up to a 93% win rate. But trading always carries risk, and no profits are guaranteed. Use the tools for education and analysis, manage your risk carefully, and always do your own research before making any trade. This is an affiliate link, and I may earn a commission at no extra cost to you.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.